Good afternoon, everybody, and welcome to our COVID-19 Town Hall series presented by Stambaugh Ness. As you can see on the screen, if you are experiencing any audio issues, please use the call-in number provided at the time of registration. This is just due to the increasing use of the GoToWebinar platform. It may take a few moments for the system to adjust to the influx of attendees this afternoon. Here are all the wonderful faces that are going to be joining you today and giving their expert advice, opinions, and stating the facts, in addition to two guest speakers, which will be introduced to you later today. And just a few housekeeping items. Like we do every week, you can customize what you're seeing right now on the screen by going to the GoToWebinar screen viewer to adjust which videos you're seeing, as well as the presentation that's up on the screen now. We will monitor the questions box of the GoToWebinar pane as we do not monitor the chat box. To help us better sort through the questions, please label your questions in the 5 buckets below so we can better direct them to our experts today. Those are workforce, technology, regulatory, cash flow, and human resources. The slide deck that you're viewing today is available for download in the handout section of the GoToWebinar panel. If you do not see that option to see the handout section, please go to the View tab at the top of your GoToWebinar pane today. And again, if you're experiencing audio issues, please use the dial-in option that coordinates with your registration rather than the computer audio. And just our disclaimer that we say every single week that all the information presented today is based on what we know on May 12th, 2020 at 2 o'clock in the afternoon, and this, as always, remains a fluid situation. Next steps, as far as our COVID-19 town halls go, our next town hall is Tuesday, May 19th, same time, same place. And you can visit our COVID-19 section of the website for additional insight and information. And you can reach out to the experts that are going to be speaking to you today via our website on our contact page. And just a little rundown on how today is going to go. We will have an introduction from Tom Moul today and our COVID-19 updates, which are cash flow and the PPP, regulatory and workforce. We will then go into our anticipatory organization section with industry expertise from Abel Design Group and Ledge Inc. We will then have our COVID-19 roundtable the next 30, 60, 90 days. A quick short section on our R&D tax credit information, a Q&A portion, and just how SN can help with your future-ready COVID-19 compliance from here on out. And with that, Tom, I'll pass it over to you.
Thank you, Kaylee, and there we go. Took a second there for the video to come up, but welcome everyone again. I think this is Town Hall number 9. We really appreciate you all joining us each week as we try to bring you, what is the latest information in this ongoing situation. Certainly a lot of changes since we began, a lot of states reopening for business now, some faster than others, and that's bringing certainly some challenges throughout, and we're here to talk a little bit about that, and you'll hear a lot about that in our latter sections of today's presentation. As Kaylee said, things do change rapidly. We still hear that there's a potential round 4 of federal stimulus money coming. We hear anything from $1 to $2 trillion or maybe more. We don't have a lot of detail on that, and certainly if and when that happens, we will dive into that in great detail for you. We still hear some demand to put a lot of dollars in the state and local governments so that they can help with their emergency services and everything else, that their budgets have been depleted. And we certainly hear that the president continues to talk about a potential payroll tax holiday. Again, that doesn't seem to have real broad-based support, not even from his own side of the aisle. And a lot of that has to do with the strain that would put on our Social Security system. But you never know. It would be a good influx of dollars in the short term if everybody had that 6.2% withholding removed from their paycheck. So we're certainly going to keep a very close eye on that. We do, as always, as Kaylee went through, have a very full agenda for you today. We have 2 hours planned. If we get through it faster than that, we'll give you a little bit of time back in your day, but we do have a lot planned with our regulatory updates, As Kaylee said, we're very pleased to have two speakers with us today. Jeffrey Abel from Abel Design Group in Houston, Texas, Adam Marsh from Ledge Inc. in York, Pennsylvania, and we'll have a little bit more in-depth introduction of those folks a little bit later in the session. We do hope you stay with us to the end. We had a contest last week in align with our anticipatory organization discussions. We ask you for your ideas of some of the changes that you see coming down the pike, and we're going to announce those winners today at the end of our session, so please stay with us for that. We will get to as many questions and answers as we can. Our folks will be answering those online as the webinar progresses. Any we don't get to in that manner, we will try to answer at the end, and if there's still overflow on that, we will be responding to you by email as the week goes by. As Kaylee said, keep the lines of communication open to us. We know it seems like almost every week, as soon as we get off this call on Tuesday, something new comes out. We don't certainly want to wait till the following week to get that information in your hands. So watch our social media sites, watch our website, watch your email. If anything major happens, we will be on top of that and let you know. We had told you before we had these town halls scheduled through the end of May. We are certainly going to do that, and it's looking more and more likely as we still wait for things like the forgiveness provisions for the PPP loans, potentially more stimulus, that we will extend as needed into June and beyond. I don't know that we'll do them every week in June if there's not a lot of new stuff coming out, but please stay tuned. We don't intend to just drop these when we get to the end of May if there's still more relevant information to be shared. May 22nd, we will be doing a webinar on cash flow boosting activities for architecture and engineering firms. Stay tuned for that. If you fall in that industry, we'll be talking about a lot of tax provisions that you can take advantage of to maybe generate some quick cash. We talked about this last week. It's not cemented yet, but sometime most likely in June, Kristi will be presenting a short webinar on preparing the new Form 941 to accommodate all of the new payroll tax credits that have been put into play, as well as the payroll tax deferrals. Quarterly payroll tax filing is certainly going to look a lot different in the second quarter than it has looked at previously. So keep checking our events page at our website. Again, we will be continuing to add events as they come up. So with that, we're going to launch into our updates for the week. As always, Chad has a fair amount to tell us about as far as the PPP program, and we're going to let Chad kick it off with that information. So, Chad?
Thanks, Tom. I appreciate that. And I think I have quite a bit of information, but maybe not what everybody's looking for, which is the forgiveness, which is still in the process. So we don't have that information yet, but we're going to cover a couple different aspects of forgiveness here in the discussion today and hit more on where we think things are headed in light of having that final guidance. So that's the first thing I wanted to mention. So moving into a couple other general comments, we alluded to last week just a little bit of kind of the tenor of the demeanor with the government, and it seemed pretty negative on the PPP front in regards to the taxability and just also some comments about need and some other items. It was very positive to see some comments yesterday from the Secretary of the Treasury, Mnuchin, in regards to being a little more open to working with Congress related to the taxability of the PPP funded expenses, and also just the 75%, 25% usage requirements related to the PPP program. So the comments, I believe, were that if there was bipartisan support in Congress, certainly that the Treasury is willing to work with them on the accommodations that they would like to see made around the program. So that was a little bit of breath of fresh air after some kind of negative undertones. So it was positive to see that. Also, what I'd like to do is share some general PPP updates on round two. And what we're seeing there is the funds and the pace of funds has seemed to slow down through 5/8 earlier this week. Only $188 billion out of the $320 total has been allocated, and that's only about $13 billion since May 1st. And the pace of utilization seems to be down versus the prior round one funding. And so that tells me that if you haven't applied yet for the funds and are on the fence, definitely this is your chance potentially to get in on that funding. The other thing I wanted to just mention is a couple of observations from the statistics that were released. The loan size in round two continues to decline. That's now down from about 79,000 in the first week to around 73 this week. So that's improving. And then the loans around 1 million are down from about 44% of the total in round one to 30% of the total in round two. So the smaller loans are coming through in the second round here. So if we can move to the next slide. I just want to provide a couple up on some Treasury issued guidance in the last week or so. Again, the forgiveness guidance has not yet been issued, but they did update a few frequently asked questions. Question 43 regarding the safe harbor provision for returning funds. They extended the due date on returning funds from May 7th to May 14th. And this would be considered to have met the need certification around the use of the funds. So there was, again, back to the question of need. There was previously a date of May 7th to have met that safe harbor, and they've now extended that to May 14th, which is this Thursday. The SBA is intending to issue guidance on how it will review the certifications by May 14th. However, that has not been issued to date. They have also issued question 45 that clarified if PPP loans were repaid by May 14th, that the business would be eligible for the employee retention credit. And that credit is, in my opinion, a less beneficial item. And I'm sorry, we're having some technical difficulties here with the audio, I'm understanding. Bear with me 1 second to see if we can try a plan B here.
Excuse me, Chad, this is Tom. We're hearing that most people are having better luck by using their computer audio. So if anyone is struggling out there using the phone, they may want to switch over to computer audio.
Is this any better?
Yes, Chad, I could hear you better.
I'm over on the computer now. Is this any clearer?
Yeah, you're better.
You sound
Chad.
good for us.
Okay. Thank you. My apologies, everyone. So I'm going to pick up where I left off, and certainly maybe if time permits, we can circle back on the back end. But I did just cover questions 43 and 45 and the employee retention credit. What I wanted to just mention in regards to that, this is a less lucrative benefit. However, it does allow businesses that aren't eligible or did not choose to take a PPP loan to get some incentives for retaining employees. So if your business was under a full or partial shutdown order, or your volume has dropped significantly, and there's guidance in the employee retention credit regarding that, you're eligible to get up to a 50% credit for $10,000 of wages and health insurance costs paid to the employees. So this is basically $5,000 per employee. If you're under 100 employees, the benefit is really for any employees that you retain. And if you're over 100, it's only for the individuals that you retain that are impacted by the COVID situation. So it's not quite as beneficial as PPP, but I wanted to make folks aware of just what that question 40 really means. There are also two new interim final rules that really was not very helpful in my opinion. I think we all had assumed that any workers counted for FTEs, so it did clarify that student workers count in determining FTEs, and it also exempted borrowers from the PPP funds from certain non-discrimination requirements of the SBA. So again, not a whole lot of new news there. The final rule on May 8th, again, was more of a formality. It amended the rules for the return of funds to show the May 14th due date instead of May 7th, but again, did not provide any guidance on the further review procedures around need on that topic. So those are the FAQ and interim final rule updates since we last spoke. So if we can go ahead and move to the next slide. I also just wanted to touch a little bit on the EIDL, the EIDL loan program from the SBA. So there were a couple changes since we met last time on this as well. So they did announce somewhat informally, I'll say, that they're reducing the amount of the loan that you can borrow under this program to $150,000. Previously it was $2 million, and that's purely due to the overwhelming demand on the SBA at this point in time. So this EIDL program has also been very popular in terms of businesses looking for assistance. And they're also limiting who can apply to only agricultural companies at this time. So if you did not already have an application in, as it stands right now, you're no longer able to submit one if you're not agricultural related. And just as a reminder, these EIDL loans are traditional loans in that they do require repayment, but they also are on pretty favorable terms in that can be as low as 3.75% interest for for-profits. I believe it's 2.75 for not-for-profits, and 30-year payment terms with pretty generous lacks of collateral, no personal guarantees, things like that. And these loans are also can be used for expenses that PPP cannot: general overhead, debt service, and other items that PPP loans just are not able to cover. So I just wanted to mention that there is a limit there. If you were looking at those loans and you were offered a loan, you really may want to think twice before you turn it down if you have any interest at all, because with this reduction, there may not be another chance at the EIDL loan program unless it's funded in another increment. So if we go ahead and we'll move to the next slide, please. I just feel it's important with this May 14th date looming in regards to the decision to return your funds or not under the PPP program. Again, I just felt it was pertinent to hit upon those items that we've suggested for a few weeks now, with you detailing in regards to what it is that you're experiencing, you're feeling, and the decisions that you're making right now to demonstrate that need for the PPP loan. And I'll spare everyone from reading the list again. But just think about the impacts, direct and indirect, and the amount of uncertainty that you're facing looking ahead in regards to volume and what it looks like in terms of collections. And take those notes contemporaneously now as you're making those decisions. We really think that's important to document your position for need, because that clarity on what that assessment is going to look like just has not yet been provided. So we just want to make sure that folks are thinking about that in the moment and not, 8 to 10 weeks from now on the back end of this process. So if you can go ahead and we'll move to the next slide. So what I'm going to try to do is take really what we're seeing as the most commonly asked questions from our last few weeks of town halls and try to address those in the presentation and in lieu of in the written text and the Q&A responses. And just hopefully this will provide some of the clarity that maybe the guidance in the Q&A is not. But a couple of general items here that we're seeing on the FAQ side. When does the cover period begin? And this is the date, currently the date the loan funds are received. So the date that the loans hit your bank account is when you would start the 8-week period of time. In the some of the discussions about changes to this program, there are talks of this period maybe being extended to when the businesses are lifted from any shutdown orders. or a date that maybe coincides with the start of a pay period. Again, those are just right now recommendations and talking points. The guidance says right now that, it is the loan funding date that starts the 8-week cover period. In regards to costs incurred and payments made, there's a lot of question and debate around what this means. And essentially our interpretation is, to be conservative, is that only counting expenses that were incurred and paid in the 8-week period currently toward the cover costs that determine the forgiveness. We think that the intent of this verbiage is to limit prepayments or accelerations of expenses from outside the 8-week period into the period as forgivable costs. But it's not 100% clear how that's going to be interpreted and how strict they're going to be with splitting things like health insurance bills, payrolls, if your pay cycles don't line up with the 8-week period exactly, things like that. So still a lot of debate and clarity to be provided. And then the final general item on this page is, what is the ordering of the forgiveness criteria? And this is another one that is undefined, but the most common interpretation and what we've seen from most of the bank's tools is that you would have first apply the 75-25% test, where you're looking at the payroll cost in relation to the non-payroll and making sure that you're at least at 75%. And then you would look at the FTE reduction. So you would look at your head counts and see if there's any impact on that from your hiring activities up through June 30th. And then finally apply the wage reduction threshold. So if you did not meet the criteria of paying individuals at least 75% of their compensation, you would then apply that threshold. Now the ordering here can be a little important and potentially in some cases very important, because if you take a percentage first and then a straight dollar amount, you can achieve or end up with significantly different results with large enough dollars involved. So it is something to watch if you're an individual or a company that may be significantly impacted if you take a percentage first or a straight dollar amount, which the wage reduction is first. So if you can go ahead and we'll move to the next slide. And I just wanted to hit on one or two final general items. The idle loan that I talked about earlier is a true loan. You can take out a loan that requires the repayment, but there was also the $10,000 idle grant that was available earlier on in the process. And that was up to $10,000. It became a loan based on $1,000 per employee shortly after it was announced. And this functions as an advance on the PPP forgiveness. So the two items here, the EIDL grant and PPP, do interplay. And the best I can give here is an example. If you have a $100,000 PPP loan, and let's just say it's fully forgiven, as well as a $10,000 EIDL grant, so you have $110,000 total from the government, one through each of the loan programs. When you go to settle up the PPP loan, and if you have full forgiveness, you would see $100,000 forgiveness, and then you would also then have a $10,000 loan due under the terms of the PPP program, and that would be payable over 2 years at the interest rate on the PPP, which is 1%. So again, the IDO operates as an advance on that forgiveness, and I just want to make sure businesses are aware of that and not discounting the fact that there could be a little bit of an amount repaid or to be repaid even if you achieve full forgiveness. And then the last general comment that we've been getting a lot of questions on is, what if I don't use my PPP funds in full during the 8-week period? And we believe that you have the option to either return the funds or continue to use them for permissible expenses, subject to the 2-year repayment of the PPP for any loan funds not forgiven. We really don't see that as leading to any negative impacts on the business if there's valid need. Our thoughts here is that the impact of making these loan proceeds that are forgiven taxable likely may have changed some individuals' assessment of their need and how they would want to utilize the funds in terms of bringing employees back or not. So we think if there was a good faith need, that the decision to return the funds instead of utilizing those will not result in some of the penalties that have been thrown around in terms of criminal charges, fraud charges. I really don't think that's what they're going for with some of the things that they have reinforced and you may have seen in the news. I think this is more just we've made a revised decision based on changing facts and circumstances. If you can slide over to the next item, we're going to move into payroll. And this is, the largest component of this program. And I think we may have gone one slide too far. Thank you. And we talked about the 75% requirement for the loan forgiveness amount, and what happens if we don't achieve that percentage. Our interpretation is that this results in a pro rata reduction. So if you achieve, let's just say, 67.5% of the 75% goal, which should work out to 90% if my math still holds true, you would be able to get 90% of your maximum forgiveness. We don't believe that this is a cliff vesting and that if you don't hit 75%, you get nothing. We've seen that discussed and proposed a little bit. That just doesn't seem consistent with the intent of the program, especially with, again, I mentioned earlier, the change in the taxability of the funds. So I just am hard pressed to see that that's how we're going to come down on that 75% rule, especially given the comments I mentioned earlier this week with the potential softening of that 75% requirement. It seems like there is at least some openness to a dialogue about, maybe bringing that requirement down a little bit to something that's more palatable given the current state of affairs and the number of states and jurisdictions that aren't fully open yet at this time. So the other item here that we're seeing quite a bit on is still that clarity around what happens if there are individuals that are annualizing over $100,000 of compensation in the covered period, or you have somebody that's has a salary over $100,000 period, and we're seeing that the costs are capped at the prorated $100,000. So you do not go to zero for those employees. You are able to take up to the $100,000 pro rata benefit or pro rata cost in terms of the forgiveness determination. You do not lose that employee's payroll. The other item to note is we talked earlier about the 75% wage requirement and that you had to at least pay individuals 75% of their wages in comparison to the base period. Individuals over the 100,000 compensation are excluded from that calculation. So really that's to protect more the staff, the front level employees from being laid off while the executives and the higher comp individuals are retained on the payroll. Again, the whole program is designed to keep individuals on the payroll, so they're less concerned about reducing the pay of an individual over 100,000 than they are somebody making 30 or 40,000, which is why they're excluded from that calculation potentially. So we think that's the two main impacts if somebody's wages annualize over 100,000. And then there's the question of what is in that $100,000 cap? How do you derive that number? And this is cash compensation only. So this is wages, salaries, commissions, piecemeal pay, referral bonuses, any of those types of items that are cash compensation. Health insurance, retirement, state and local taxes, and other are payroll costs, but they're not considered cash compensation subject to the $100,000 cap. So you can have an individual making the $100,000 or limited to the $100,000 and also get their health insurance, retirement, and other taxes set another way. Our bonus is allowable, or I also maybe say is hazard pay allowable if you want to reward employees for the risk they're taking to continue contributing to your business. Yes, and to the extent that they don't annualize over $100,000, as we mentioned above. And again, I will also preface it. I know Kayla gave the disclaimer early on in the presentation. All this is based on what we know today and the guidance. An update from the Treasury on the forgiveness could change this this afternoon or tomorrow. But that's our take and our opinion right now. Is the only limitation on the bonuses is the annualization. If you can move to the next slide, we have just a couple more items on payroll. Again, this is really the driver of the program, so we wanted to make sure we cover some of these well. And again, a lot of folks have asked about, will the comparison of an 8-week cover period to a 12-week quarter be corrected? Obviously right out of the gate, as we demonstrated a few weeks ago, even if you pay the same compensation to an employee based on the way the calculation works, you will have a shortfall of more than that 25% that's allowable on compensation. And We are certainly hoping that this is corrected in the final guidance, either by annualizing or averaging the compensation of the 2 periods, and that way they're on a more comparable basis. I just really can't imagine that they're going to let that stand and really drive folks to pay extra wages versus the base period to achieve forgiveness. So I don't think that was the intent. I think it was just hastily written guidance given the circumstances. And then the last item, and this one has probably been up for the most debate internally amongst our teams, is how do we handle the retirement expenses for purposes of the PPP forgiveness? Many companies have not yet funded their 2019 retirement plan contributions in full. They have till the extended due date of their tax returns to do so. Can we fund 2020's retirement, which would be incurred and paid in the cover period ahead of 2019's? And what does that do for our cash flow looking ahead? And we think that, we are looking at the need to fund 2020's retirement contribution to really comply with the spirit of the law as it's written today. And maybe that becomes just a safe harbor funding portion. But there's also talk that might they look and say, we'll just allow you to deduct 8/52 of your annual payroll contribution, annual retirement contribution. That will certainly make it a little easier, and you wouldn't have to necessarily, fund ahead on 2020's contributions while you're still working on 2019's. So we're hoping that that's a reasonable accommodation that can be made, because that can create some very interesting situations here with the timing of the retirement contributions. So those are what we consider the hot issues for payroll. We're going to slide over now to just a couple items on the covered costs, the other covered costs, things like interest and other items. And the first item that we want to hit upon is a little bit about interest. And line of credit interest has come up quite frequently. And how does that qualify for forgiveness? And does it qualify? It's a little bit unclear. There's some inconsistent use of the word mortgage as it relates to the interest across the existing guidance. We think really the intent is that all loans that were in place by February 15th are eligible. We think that's where the guidance has headed. But there's some specific references to the term mortgage in regards to in the forgiveness expenses. So it's not 100% clear what that's going to look like. And if the line of credit interest is permissible, how much of the interest is allowable? Are you locked into a ceiling of the balance on the line of credit at February 15th, 2020? Meaning that if you had to borrow more on your line of credit, that portion of the interest is not allowable, or is it whatever the line of credit balance is during the 8-week cover period? So again, there's a little bit of discussion and debate around how that interest would be quantified for the lines, and really no clear answer to date. And also, a lot of folks have been asking about liability insurance. That's as necessary of an operating cost as rent and interest in some folks' eyes. But unfortunately, liability insurances are not eligible as a covered cost. And that also extends to workers' comp insurance, life insurance, things like that. They are not permissible as it stands today. So if we can move to the final slide on our FAQs, and hopefully this is helpful for some. Also, there's a question about utilities, and there were a number of utilities spelled out in the guidance as permissible: electricity, gas, water, transportation utility, which is fuel for business vehicles, as we learned. Telephone and internet are specifically mentioned in the guidance as permissible. It is not clear if the SBA will expand that to allow other utilities, trash, sewer, cable, security fees for security monitoring and things like that, as eligible costs. One would think that it would make sense that these are very, very similar to the types of utilities that were listed. But is that list, meant to be all inclusive, or is it just an example list? So we're looking to see what that guidance will provide as well. The related party rental question, and how does that factor into forgiveness, is another common item. And our interpretation is that provided that there's a lease agreement in place prior to February 15th, 2020, those related party rentals are permissible for forgiveness purposes. It's unclear of the impact of not having an agreement with a related party prior to February 15th. and if the lender will accept the consistent payment of rentals on a monthly basis as acceptable documentation of the arrangement being in place. One would think that past practices and continuation of that practice at a similar level would allow those expenses to be allowable in the calculation, but it's just not clear at this point in time. The other item that I have seen a little bit is, will they look through that lease payment and look at the interest that you pay on the underlying debt if the property is owned by the owner or another entity. I really have not seen anything in the guidance to support that, that look through. So, my opinion is that, as long as you have the lease agreement in place, that the rent would be permissible in full. And then lastly, what about other leases, equipment, software, other items that we have a contractual obligation for, copiers, postage machines, items like that. And again, as long as the lease agreement was in place, the guidance is not specific to real estate. So our interpretation is you are able to deduct those costs for non-real estate leases as well. So if we can move over to the final slide, I wanted to close on just the broad forgiveness reminders, and hopefully those FAQs helped clarify some of these items. But just keep in mind, the whole forgiveness process, as I mentioned earlier, we think starts with the 75-25% analysis. So the 75% of the forgiven costs have to be payroll. And then you look to the FTE measurement for your full-time equivalents, and then look into your salary threshold comparisons. So we think that's the faucet and how those loan funds are gonna funnel through. And then just some strategies to monitor around forgiveness. And again, these go back to what we've been talking about for several weeks, is think about getting your employees with reduced schedules back to full-time, your furloughed employees, bring them back in to the extent possible. Looking to restore your salary reductions that you may have had, bonuses that you generally have paid. As long as those are generating productive effort from your employee base, we think those are still good decisions to make. Again, the taxability of the forgiveness may weaken some of that benefit, so that's where the emphasis on productivity comes into play in regards to just that decision-making process. But again, if you want to maximize your forgiveness, those are some of the levers that we would suggest you give consideration to in the grand scheme of things. So that is everything I have. And again, I apologize for the audio issues, and I'm going to turn it over to Tom for some regulatory updates. So thank you.
Well, thank you, Chad. Certainly, your piece is much awaited each week. Everybody just really interested in those developments in the PPP loans, and I'm sure more to come in future weeks. On my end this week with the tax end of things, I don't have a lot of new things. What I have is a lot of maybe we'll just classify it as speculation, just things that you might be hearing that I just wanted to share, but with a big emphasis that most of this isn't set in stone yet. So we'll start where we normally start, and that's with these direct payments to taxpayers, the economic stimulus payments. On May 6th, last Wednesday, a day after we joined you, they did issue some additional FAQs, and most of those regarded around payments that went out to deceased persons. We talked about that a little bit last week. Secretary Mnuchin in the previous week had said, no, it was not our intention to allow those payments to go out to deceased folks. And in fact, they put FAQs out stating that and giving you instructions on how to return those payments if you had received those for a loved one. However, what we also have read and have heard is FAQs are not authoritative. So we don't know that when they finally get to final regulations, that will be the case, because like so many other things, we are hearing that was not congressional intent. It was not the intent to claw those payments back. So I honestly think the best advice we can give you on those, if you are in that situation, is sit tight. I think once you send that check back, you're not getting it back, even if you're entitled to it. You may need to send it back, but I would really just recommend a wait and see approach on that. And I know that's probably not the advice you were looking for, but I think it's the best we have as of now. A lot more payments went out last week. Another round went out as of May 8th. We're being told over 130 million people have received economic stimulus checks now, totaling over $200 billion being distributed. But we know there's a lot of folks out there. I had a long talk with a client this morning who just has not seen theirs yet. They're trying to go on to the IRS website to get your payment, and it's just not registering their information. So again, we just ask you to have some patience there. Remember, worst case scenario is if you don't get the payment by direct deposit in this round, if you don't get a paper check over the summer months, you will be able to reconcile that on your 2020 tax return when that's filed at the end of this year. So I think we're going to see a little bit more on that. In fact, we even hear that there's some talk about another round of checks, or maybe even on the extreme end that it will be a monthly payment, but that's all speculation at this point. There were some changes in regards to the employee retention credit. I think Chad already did a good job of going over those. It mainly revolves around someone who does decide to give their PPP funds back. If they qualify, they can jump into the employee retention credit. But as Chad said, there's a number of restrictions there on whether you're truly able to utilize that or not. There was some additional FAQs in regards to the employee retention credit put out as well. And one of them was kind of controversial, and I think it may need to be overturned. And it dealt with if you have employees on furlough, you're not paying them salary at this point, but you are still picking up their health insurance cost. This FAQ said that that health insurance is not eligible for the employee retention credit. And that seems to be in contrast again with the intent. We've said that so many times, I think. Chad said it, we said it last week, but some of the interpretations coming out seem to be a little bit off base from what our understanding, what Congress has stated their intentions are. So if you do have that situation as well, that your business is shut down, but you are carrying some costs for folks, we need to monitor that one, because the guidance we got last week was a little bit confusing on that. PPP expense deductibility. We spent a lot of time with this one last week. This was kind of the bombshell of the previous week when they told us that, yes, while your PPP forgiveness is not taxable, the expenses associated with it are not deductible either, thus pretty much canceling each other out. As we talked about last week, Congress, the AICPA, a lot of other industry trade groups spoke loudly immediately on that to say that was not the intent. And sure enough, I think probably even maybe while we were speaking last week on May 5th, there was bipartisan legislation introduced into the Senate to overrule IRS Notice 2020-32 and to allow the deductibility of those expenses. That is still in committee right now. It's still working its way through, but I think we are holding out hope that that announcement the IRS made, which is going on 2 weeks ago now, will be overturned. In some of the prior weeks, I've talked about kind of monitoring how the states then treat the forgiveness, and I think that's really to some degree on hold right now, because I think the states will probably sit back and see how the federal kind of washes out here and determines what's, what comes down from that before they make their statements on that. I think we can't overemphasize the fact, though, that the states are going to be aggressive in their enforcement of taxes. And I know my fellow presenters were even a little bit nervous about me bringing this one up as an example, because I'm not trying to make a political statement by any means, not trying to take sides on this. I'm only giving it as an example. I think most of you that follow the news know Governor Cuomo from New York State has been pretty prominent. His press conferences are covered on most of the news channels. New York obviously has been a hot spot of COVID-19, and they've gotten a lot of help from folks from all over the U.S., healthcare workers and other emergency personnel coming into New York to work in the hospitals and work in healthcare. It probably wasn't the greatest of timing, but it really wasn't an incorrect statement last week when Cuomo said all of those folks from out of state that have come into New York to work, if they are there on site for 14 or more days, they will be subject to New York State income taxes. And I got a lot of negative press saying, well, how could you, that's kind of rubbing salt in the wound of these folks who have come in, put their lives at risk to help, and now you're going to hit them with the tax. Well, that is a law that was already on the books in New York, and it's on the books in most states. whether you needed to say it at that point in time that they're going to enforce it or not, we can all judge that. But I think those are the type of things we will see states truly will enforce. They are going to dig deep into their state rule books, and I think they're going to be more aggressive in looking for revenue wherever they can get it. And that's only one small example. Many businesses have what we call nexus or presence in other states and may not even be aware of that, and may have a liability to that other state, whether their people are actually going into the state to perform services, to install product, to repair product, whether they're delivering product into that state, sales taxes that can be just as much as being delivered by common carrier. And they may not have been paying taxes to those states in the past. We really encourage you to be proactive with that now. It's better to kind of come forward with that, get your tax house in order before the states come after you, because really they can go back as far as you've had presence there if they come after you. So that's, I know I'm being a little bit on the negative side there, but that's just a big warning that we can't say enough, is don't overlook state taxes when you look at your tax picture. Now, let me shift from the negative to the positive. You hear me talk each week about the benefits of the research and development tax credit. I'm going to talk a little bit more about that later today in the roundtable. But really good news last week, a proposal again that came in the Senate. Again, it had bipartisan support, so we look at that as a big plus. Something called the Forward Act was introduced. And that is a proposal to expand the research and development tax credit even further. Three main prongs of it is it would make the credit percentage higher. So out of your qualifying activities and qualifying costs, a greater percentage of those would lead into the credit. So that's more tax savings for you. Greatly expanded benefits for startup entities. And that would now be defined as entities in their first 8 years of business as opposed to 5 as it was before, and with higher thresholds of gross receipts. So a lot more companies would qualify for the startup benefits. And also something that we've never had before, and that's the inclusion of certain training costs into the credit. Not all training costs of your employees, but certain technical training costs may be eligible for the credit. Again, can't emphasize enough, that's not law yet. It may not end up in law in the in the same status that it was introduced last week, but it's a very positive, I think, that our legislators are recognizing the importance of innovation and the things that are going to come down the pike to get us to the new normal, and some of the things that I think our guest speakers will probably speak about today. What will become the new normal is going to require investment by all of us in our businesses, and we may get some tax break for doing so. A couple of other things you may have heard. Again, they're only discussion at this point. There's been some talk that the July 15 filing date, as you all know, July 15 in essence became the new April 15, with most federal taxes and a lot of states following suit. Now there's some talk that may be even pushed to September 15th or even later than that. So we'll be keeping an eye on that. We know as the lockdowns continue in some states, the inability to get out and about and get in front of your tax preparer, get some things done, still is difficult. We may get a little bit more time to file, and more importantly, a little bit more time to pay any taxes due, to hold on to that cash for just a little bit longer. Now, one caveat I would throw out on that is, remember, you may still have estimated tax payments that are due for 2020. So the longer we push that, we get the benefit of the time value of money and holding on to our money, but we may have some pretty significant payments to make later in the year if they all kind of become bunched together. So that's, I think, a pretty good summary of what I've noticed that's occurred this week on the tax and regulatory front. So I will stop with that and hand it over to Kristi to talk about workforce.
All right, thank you, Tom. Hello, everyone. Lots of stuff constantly moving, and we do our best to try to keep it at least fresh and new and just reinforce those areas that are important or of concern for us. So one of the things that I wanted to talk about with you today is that there's a lot of differences between federal, state, and even local. And how do you make sense of that? So it's really hard, especially when you're trying to run your business, make decisions about staffing. Who do you call back? When do you leave them on unemployment? And so it just becomes a very webbed type of situation, if you will. So for those that are not in Pennsylvania or don't have employees in Pennsylvania, I do apologize because I want to talk about one specific thing to Pennsylvania. However, I think there is still a key message for you in all this as well, if you're not in Pennsylvania, is that you need to be very in touch, if you will, with state and local decisions that are happening, especially if it flies in the face of federal, or if in like Pennsylvania, you have a disagreement between state level decisions and then more local decisions. So right now with the stay-at-home order and slowly opening businesses, there's definitely disagreement as to how that should happen, when should it happen, and so forth. And there's people protesting or, you know, kind of just saying, I'm not going to listen to you at the state level anymore. I'm going to do what I want. And so the state has responded indicating, well, if that's the case, and if you are an employee who works for a company that's not listening to the state rules and decide to do something different and follow the local guidance, then you could potentially, as an employee, refuse to go to work and stay home and collect unemployment. So why I share that is because prior to this week, I have been telling everybody that you need to just make employees aware that if they refuse to come to work when work is available, that they could jeopardize their eligibility for unemployment. Well, as we can see, that might not always be the case. So there's a few things from an employer perspective that I want to talk about. And the unemployment is one example. There's definitely others that we could relate this to, but to what extent are you willing to take risk? That's your own personal choice, you and your organization, as to how you want to handle that. But I want to caution you that in the decisions that you're making, the policies and procedures that you're defining due to this rapid change with a lot of people going remote and so forth, and also trying to just listen to the government guidelines and so forth, that you be careful not to show favoritism. You be careful not to discriminate in any way, shape, or form, following some of the same guidelines that you would for other types of employee matters, because that's where I believe it could potentially fly in our face, right? We want to do the right thing. We want to bring people back to work. We want to allow them to leave their home, and we're trying to do the right thing. But if we're not extra cautious, we might actually hurt ourselves in that process. So I wanted to just speak about that a little bit today, because I continue to see where we have potential areas for maybe a hot spot to bubble up. I'm not trying to be Debbie Downer or negative Nancy in any way, but I do want you to at least give extra thought as you're sitting down and saying, okay, which employees can we allow to work remotely, either full-time, partially, or not at all? How do we measure performance with each one of those scenarios to make sure that we're getting the quality and quantity out of our employees? So just keep that in mind as you're moving forward here, and hopefully there's a little gold nugget in there somewhere for you. Two other things that I want to talk about. We did receive an inquiry prior to the town hall this week about summer childcare. I do believe more and more employees are going to be faced with some of these hard decisions. One, if you're reliant on having summer camps as the primary source of childcare, if those are restricted or the hours of operation are changing or they're not happening at all, it could potentially impact your employees' ability to work full time. Additionally, as we phase into the returning back to work, there will be some child care facilities that open up right away, some that will be slower to open up. You're also going to have probably a scale of some being really good with providing PPE and sanitation and cleanliness and so forth, especially those that are state certified and regularly are checked up on by the state or locality. But if it's just somebody who does it in their home, you may not have that same level of precaution. Therefore, your employee may not feel safe dropping their children off to their normal childcare provider. So with that being said, if they then try to find childcare elsewhere, there might be a waiting list, or they just isn't any available. So what do we do? How do we handle that? In the moment, I'm just going to suggest that you keep as much documentation as possible surrounding the circumstances. That way, if you pay them for the extended FMLA and you want to utilize the payroll tax credit, have enough support so that way if you're audited at any point in time or asked to reconcile the payroll tax credit, that you feel pretty confident you did the best that you could and your employee did the best that they could to try to at least get back to work, if not part-time, full-time during the summer. And the last thing I want to talk about here, and I'll hand it over to Rick then, is that we did receive one client reach out to us and said, hey, we got a notice from unemployment that one of our 1099 individuals filed. And so not quite sure yet what's all happening with the various states and the federal portion of their websites for handling the federal stimulus part, if you will, that $600 per week. But depending how the individuals who normally don't collect unemployment answered certain questions, it might throw up a flag for you and your organization, where now the unemployment office is saying, hey, can you tell me about the wages and so forth that this individual earned while working with you? So what I would recommend is just making sure that you do have everything in place for that 1099 individual, any contract, any W-9 form, anything that you can provide to prove that they're truly not an employee. Because if there's a gray area, I could see the potential for an audit potentially could happen to just come in and investigate and say, hey, should this person really be 1099 or should they be an employee? We know prior to this whole COVID situation that 1099s were definitely an area that many states were looking to narrow down on or place further restrictions. So this really gives them maybe one more reason to start poking in that area. And I just want you to be precautious. Take some time now, if you have a little downtime, and just make sure that all your ducks are in a row, if you will, or that you have all the right documentation to support somebody being an independent worker rather than a W-2 employee. So I am going to hand it over to Rick. Rick, if you'll join me on the screen here, he's going to share a few words with you, and then he's going to introduce our guest speakers. So I will see you in a little bit back at the roundtable.
Thanks, Kristi. And again, this phase of the town hall meeting is where we have introduced this concept of a roundtable discussion with the intent of trying to have people think about designing their roadmap to reentry, and really trying to encourage the disruptors that you're going to face, and applying many of the concepts that we've shared with you from the author Daniel Burrus from his book, The Anticipatory Organization. Dan Burrus is a well-known futurist and speaker, and Stambaugh Ness has embraced that concept some 2 years ago and really have tried to develop critical thinkers to apply those concepts. And we talked about firms dealing with a 30, 60, 90-day plan, and talked about topics of facilities, what you should be thinking about, workforce, technology, your general operations. A key principle that Burrus often shares with attendees and those people on his webinars is that we all realize that right now we're living in very, very uncertain times. And he states that you must carve out time, a couple hours a week, to identify those activities, those events that are going to be disruptors in how your business is going to operate in the future. And to shift out of that, we call it reactive mode. And everybody knows what that is. We're there rushing around trying to put out fires. I give kudos to Chad and his team with trying to react to these rules and regulations in the PPP, and still waiting for, what are the rules of engagement. This whole idea of just being in a mindset of reactionary. We have to shift into this preactive mode, identify problems, anticipate them, and pre-solve them. If you do that and you apply that principle, your ability to move forward, take action with greater certainty certainly allows you to take on those actions with much less risk. Last week in our polling questions, we asked about what was the level of interest in the participants to again have Stambaugh Ness, not unlike what we did with Chris Baker some weeks ago from Hillman, talking about what should people be doing, thinking about facilities, and other attorneys talking about the workforce and the employees. The gentleman from Barley Snyder. And it was a resounding 97% said, yes, we did. So we're fortunate today to have two individuals to join us as presenters. And I'm going to be asking Jeffrey Abel of Abel Design Group to join me now. So if he wants to unmute himself and click on his webcam, as well as after Jeffrey and I get to talk for a little bit, then we're also going to have Adam Marshall join us later from Ledge Inc. So with that, I see Jeff has joined us on the screen. Just a little bit of background. Jeffrey's the managing principal at the Abel Design Group. They're located in Houston, Austin, and Denver, about an hour behind us a little bit. So as we've been talking, but we just asked Jeffrey to join us today in order to share with us, some of the things that, he's seeing in the design area, and we'll share some, question and answers, possibly more of a back and forth conversation between Jeff and myself. But with that, Jeff, if you wouldn't mind, just introduce yourself, tell us a little bit about Abel, what you guys are doing, and what you're seeing in your industry. I think you're still muted, Jeff. No.
I am unmuted.
Now you're good.
There we go. All right. I had both my phone and my computer on mute. I apologize. But Rick, thank you so much for having me. We're 1 hour behind, but maybe 30 degrees difference as well. We've been enjoying our nice stay-at-home, work-from-home weather. I'll tell you that. So I started Abel Design Group, which is an architecture and interiors firm. We do interior design, interior architecture, and design ground up. As you mentioned, Houston, Austin, and Denver. Started that back in 2001. And our main focus when we started was tenant improvement work. And over the years, we've graduated, so to speak, to other disciplines. And we now cover corporate office, restaurant, retail, hospitality, and a little bit of higher education. I'd love to talk a little bit more about the corporate side, the tenant improvement side, office space, and restaurant. I'd say that most everyone that is on the call either goes to an office or used to go to restaurants, right? And that's where we're seeing quite a bit of change. But across the board, all sectors for us have experienced a fair amount of change. And most notably, from the business side, we saw all of our restaurant work just immediately come to a stop. Everything was put on hold. So that was a little scary. But of course, long-term projects where financing was already in place and larger scale projects. We have a 36 floor project in Houston that is a vertical mixed use, hotel, restaurant, condos, ballroom. That is still plowing ahead. It's been financed, and they're looking to the future. But when it comes to office space and restaurant, everyone has been asking, what should we do? What can we do immediately, the reactionary part that Rick talked about, in order to get our employees back to the office? Talking about clear screens, social distancing, shutting down break rooms, creating one direction circulation on within the floor so that people aren't passing each other and coughing in each other's face. It does seem like rather temporary solutions to a much larger issue should this virus continue. And that is definitely one of the challenges that we have as architects and designers of trying to figure out a solution for tomorrow, right? And Rick, you had asked me that offline before, what are we going to see in the future? Well, I think it all starts with looking at the individual and the physical space, as well as the mental health of the workers. And I'm talking about corporate space right now, office space. So you may have people riding public transit. That's stressful unto itself, but maybe it's compounded stress just from close proximity of people and being worried about contracting the virus. They arrive at work, they have to go up an elevator. Once again, riding an elevator, you're next to a few other strangers. You don't know where they've been. Maybe that causes some stress for some people. You go to the office space and you sit in your workstation or your benching, and you're 4 to 5 to 6 feet away from the next person. Is that stressful? You want to put your lunch into a refrigerator in the break room? Well, should you touch a cup? Should you clean up after yourself, and are you spraying everything? So you can take it to an extreme, and we're actually coming across this where our clients are asking us, should we shut things down? Well, what we have had to step back and think of is, all right, different categories of clients. Those that are in a lease that need to modify their existing lease space and have no plans on changing their location or their lease anytime soon. Others that are willing to adapt to a new design because they're in the midst of possibly designing new lease space, about to move locations. They have a great opportunity to address this and hold their employees and truly understand their wants and fears. And then, of course, you have the group that has said, you know what, we can now work from home. Working from the office has been proven. Working from home has now been proven to be somewhat successful for different groups. How do we address that? And what is left over in terms of the lease space? Do we only design conference centers for those all hands on deck meetings? Or for client presentation? And does the employee just vacate the space? I pulled up a couple quotes because I don't think anyone knows the answer. Warren Buffett was just quoted as saying, the supply and demand for office space may change significantly. A lot of people have learned that they can work from home or that there are other methods of conducting their business that might have than what they had originally thought of doing a couple of years ago. When change happens in the world, you adjust to it. Okay? Well, that's one billionaire's opinion. There's another, former Google CEO, Eric Schmidt, thinks that office space will actually be in greater demand after the coronavirus pandemic. He feels that the need for taking people out of workstations into offices will increase, and therefore increase the actual square footage of a lease space. So we have so many different opinions, and every company is different. And I think what Tom had alluded to a little bit of, not trying to make this political, but different regions of the country will behave differently as well. In New York, for example, going to workstations was critical because the cost of a lease space, the return on your investment. You needed to have more square feet per person because, more people per square feet because the rent was so high. Here in Houston or maybe in Denver, we have a little bit more space, the rent is a little bit less, and we can afford to have those offices. And so I think that we'll see growth behave, different types of growth in different parts of the country, really related to the cost of lease space. So that Rick, you said we're going to have a banter back and forth, and I apologize, just going down that, that rabbit hole. But I thought it was very interesting that we had some very successful people, Warren Buffett and then Eric, having very contradictory positions.
Jeff, just, I refer to Daniel Burris, and as I said, the firm works with the Anticipatory organization, and we see this pandemic as something that we refer to as a soft trend. It's certainly something that's happening, but it's going to change over time. We get a vaccine, there's going to be a change. So when you're talking about office space, and listening to the other conversations and panel discussions, I don't think it's going to be one or the other. I think it's going to be, a combination or a new hybrid. So for those people that really feel that you're not going to go totally virtual or remote, what things should they be thinking about now to, in the design world as it relates to, office space? And because I have to think there's got to be a little bit of lead time with this stuff. It's not going to happen overnight.
Well, we have seen a sub-market of COVID-19 products, if you want to call them that, just pop up immediately on demand. If you need them delivered to your space, plexiglass screens. We've even participated in a charrette. For those of you that don't know, a charrette is a very quick group design session where you come up with an idea and then you try and build it very quickly. And we're prototyping this with a local fabricator. And there were many sketches from how do you protect the receptionist, because that's your front yard. Where do you house gloves? Where do you house disinfectant? What about wipes? And so we're going to see the office space change to accommodate some of the physical needs. Maybe you have automatic doors that open both directions, or or a button that you can press at your entry door so you're not holding the handle. Our problem that we're finding is that predicting which groups need to be in the office, we've already seen it ourselves that even within our design firm and architecture firm, there are certain times at which someone working from home is more efficient than working in the office, and then the inverse is true. And so what we are seeing and adapting within our own office is that we're increasing certain spaces so that we can collaborate together, but not right on top of each other. We've installed a couple more TVs in some of our conference rooms so that we can have 2 or 3 people in a conference room and then work with someone from home. So we're seeing that blending, as you mentioned, of the work from home and the work from office. Not sure if I answered your question there, but it is ever changing. And as we talk to people, everyone has an opinion, and people are just plowing ahead with what they had designed, and they're rolling out multiple offices and they're not making any changes. Others are pulling back. We had a tech company who was originally 4 floors. They're now only going to be 1 floor, and that's going to be mostly conferencing. We have a law firm that was going to be 3 floors, and they're now changing their middle floor to be pure conference center. So the physical space is changing, but also addressing the employees' wants and needs. The work from home is now going to be a corporate policy, I believe. We're going to have to figure out how to schedule that, which also leads me to, by scheduling the work from home, we're seeing more need for hot desking and hot offices. So you may say 25% of my workforce can work from home, and then you have a rotating schedule. Well, then if I have reduced my office space, then they have to share a desk. And then what is the policy to disinfect or spray for the next person that comes in the next day? Very interesting. It's a revolving puzzle.
Not unlike the regulation. Not unlike the regulation, all that we're dealing with, and you're dealing with it in your world as well. Anything that particular, and then we're going to shift over to Adam here in a second. And Jeff, if you're able to just stay on, just in case any of the participants, we do have a live questions that come into us. And if you could stick around for the Q&A, so I would encourage anybody that has any questions for Jeff. But, you know, I think that this whole idea, and I know talking with different people, particularly in the architectural engineering area, things still seem to be continuing, but anything you see out in the horizon changing, you know, out Q3, Q4, maybe into 2021?
Yeah, that's a good segue into the restaurant design. A major change is the delivery service of food. And so we're designing cloud kitchens or dark kitchens, commissary kitchens. And these are off-site kitchens that a restaurant may rent kitchen space, develop their own menu, deliver food of their own menu to all of their customers. And what this does, it frees up their in-restaurant kitchen. And so this was a trend even before COVID-19. But it was, I guess, enhanced and accelerated this need of having a quick operation center for food delivery. So we're seeing that quite a bit. When it comes to hotels, it really comes down to removing the stress of sleeping in another space, whether or not that room has been disinfected. That's really what it's coming down to. The hotel that we're designing, a Thompson Hotel, they've been very concerned about the user experience and how do you get from ground floor up to the room and safety precautions in between. So I do see that hotels are going to have to adapt as well. That restaurants, for the most part, are going to see the biggest change. Like, you know, self-service Coke machines are going by the wayside. Buffets may be disappearing, and they'll have to adapt their menu or adapt their offering.
Interesting. Well, Jeff, again, thanks for joining us, and if you can hang in there, continue to monitor the session. And at this time, I was going to ask Adam Marsh to join us, and I'll do a quick introduction. So, Adam, if you want to turn your webcam on, and we'll take it from there. I'm glad to introduce Adam Marsh. Adam's the president of Ledge Inc., and Ledge Inc. is a full-service management firm comprised of experts that have been providing engineering quality management systems for well over 25 years. They primarily assist organizations in increasing profitability by improving operations, quality management systems, and reducing risk and ensuring compliance. Adam and his team work with a lot of different industries, and that's why we thought of importance to share this from a manufacturing side, whether it's industrial fabrication, coatings, medical device, automotive supply, food service, and heavy construction. So with that, Adam, we would just hope that maybe you can share from an industrial engineer's perspective what you're seeing, what are the things that your clients are saying, hey, it's a new world that I'm going to have to deal with here in the manufacturing sector.
Thank you, Rick. Really appreciate you guys having us for this today. So I would say, well, sir, first off, our business, we're mainly focused for the quality world, where we're helping companies to achieve certifications and things like that. And that kind of feeds nicely into this, where we happen to do a lot of food safety work. And the food safety customers of ours almost have a jump start on everybody else, because they've been planning for how to keep pathogens out of their food for a long time. So we're able to kind of use some of their guidelines and things that they've done in history and apply it to, okay, now how are we going to protect our staff from bringing this into our workplace, and not only getting it into the product, but preventing it from, even entering the workplace, period. So it's a little different look at it, but a lot of the practices are the same. So I was going to kind of break it into two things. One is, number one, how do you protect your staff? And two is, how do you protect your business? On the staff side, I really see sort of two options. And that is, number one, we have to either spread out our business so people aren't on top of each other. Okay, so that's either using equipment or facilities that are designed so people aren't in close quarters, or two, we got to stagger times if you can't allow for the spread, on one shift. So we think first off that arrival time. So we want you to really look at think of the potential hazards that are in your business. Food safety companies do this with something called HACCP, which is a hazard analysis, critical control point analysis. So they actually look at their business and say, here's where things could be a problem, and here's how we've mitigated that problem. This is the perfect opportunity to do that with your staff and where they interact. One of the most common interactions is on those arrival times. So if you can look at staggering your arrival times when people come, you could cut in all that crossover as people are walking in the doors and coming in together. So if that's a 15-minute, you get 2 people coming in every 15 minutes versus 50 people coming in every hour, that would be a really big help. We're also seeing a lot of companies starting to avoid production meetings, avoid that planning meeting where they're getting everybody together and saying, here's what we're doing today. They're delivering a message either by email or by posting, here's the work, go to it, and sort of, stopping all that. One of the things, and I think this ties nicely back to what Kristi was talking about on the HR side, we're seeing a lot of companies start to stagger shifts and allow a lot of flexibility with their staff, where we can limit the number of people in the building by saying half our staff now works at night. It's going to take more management oversight, but I think where it would really help is families that are trying to get back to work, or you're asking families to come back to work and they don't have that childcare yet. So they may be able to still come in on another shift, and they might be able to separate, kind of mom can stay home in the morning and dad goes to work, and then mom goes to work in the evening and dad stays home, So I think you could really help your staff get back to work with that. And I think it's going to take a lot of flexibility and understanding the next couple months as people are trying to figure out how they're going to handle this, and especially with schools, being closed and might be for an extended period of time.
We're really encouraging firms to do a survey, find out, what the availability and what are some of the constraints, so that you can plan, like you said, to maybe bring them in waves at different times to maybe mitigate some of these childcare issues.
I spoke with a really interesting local company yesterday that has a husband and wife that work there. They now have allowed them to split their shifts, so one works at night, and they literally trade the kids off in the parking lot. in the car. So the kids drive in, one clocks in, one clocks out, and then they go home. So they found ways to make that work, and still get people back in the office. I think you have a unique opportunity to separate some equipment, because some of your common rooms might not really be in use right now. If you can't use that lunchroom, or not many people are going to be in there at once, if you have other rooms that are tight, can you bring some of that equipment into the common room and start to use it in a way that's further separated from other people? We've seen a couple of our customers that don't have a lot of bathroom facilities actually bring in extra bathrooms, bring in porta potties and things like that, to increase or decrease the number of people going in. And then we're seeing a lot of people start to leave doors open. So how can we reduce the number of contact surfaces that we have? Let's leave doors open. And if that's a bathroom, maybe you need to put a separator that people walk around, but you can reduce the number of doors people have to open. Everybody's talked about these Lexan screens people are putting up. We've seen people put it right down the middle of a conveyor line. So that's pretty interesting. So if you do have to talk to each other across, you're not spitting on each other. Kind of an interesting approach. I wish maybe we had stock in the Lexan companies right now. I'm really interested, though, in how companies are going to do a long-term plan here. I think you're going to have to develop a cleaning plan and schedule for your business. So what rooms get cleaned? When do you clean it? And how do you document that cleaned happened? So think back, I'm kind of a quality guy in an ISO 9001 world, where we say what you do and then do what you say and prove to me you did it. I want people to sign off that clean happened. So when we have shift 1 ending and shift 2 coming in, I would like a clean to happen in between at that workstation, and then documented that clean did occur. I think that would help a lot with your liability. I think you're proving that you're doing something, and you're able to walk around and check that stuff happened. So now I'd really like to talk about thinking about strategies on protecting your business long-term, as this could have, it has had an impact, but it could have a long-term impact, and mainly on the supply chain side. We are in a world where we used to try and forecast everything and plan for our inventory or our safety stock and things like that. I think a lot of those numbers are out the window, and we need to take a different look at this. So you got a really interesting chance to look at local sourcing. We don't know what's going to happen with China long term, and I have a feeling that there's some tariffs coming down the road and some penalties going to be enforced on China, and who knows what that could do to your supply chain. So now's the time to look into that and find alternative sourcing. Uniquely, we have some really good manufacturers. We're in central Pennsylvania, which happens to have an excellent manufacturing base. There are a lot of die makers here that have lost a lot of work over the years to China, and they've upped their game. They're doing a lot better than they used to do. Their pricing is competitive now. It's time to get into those guys and start getting parts made here rather than relying on China for those parts, because I don't know how long or what kind of impact the prices are going to be there. I look at inventory as something we've been trying to reduce for all these years, and we've tried to go lean and lean. But in a world of unrest where you don't know what could happen to your supplier, I think your safety stock needs to increase. I think you need to make plans for that, especially on high risk items that are coming from overseas or items that you can't multi-source. And I think, somebody like, or building your WIP internally is going to be really important. So you can stage that for that split shift. I've got a split shift and half my guys are coming in the morning, and I need different people in the afternoon. They do different things. We're going to have to be able to stage that work in progress so we can really make sure everybody has work to do. I look at your opportunity right now for automation, and we kind of circle back to your R&D tax credit that you guys talked about. If we're bringing large amounts of work back from China, and that I see that as a good possibility. If we're doing high volume work, which we don't tend to do a lot anymore, that high volume work, we're still going to be price competitive. And to do that, automation is going to be a key. So things like the R&D tax credit and things, now's the time to invest and plan to bring some of these items back. The last thing I wanted to talk about, and Rick, you and I didn't catch up on this one yesterday, but I think it's really interesting. In the manufacturing, the production world, we have a lot of training opportunities right now. We've been complaining for all these years that it's 3% unemployment and we can't find anybody to do work. Well, most of the service industry just got laid off and has nowhere to go. And they might not have anywhere to go for a long time. So I think we have a really interesting chance here to change that workforce from a service economy back into more of a production economy and start thinking about, I need to get people and I need to train them, and how are we going to do that safely? So you have this neat chance to do that. And it looks like, you guys talked about that Forward Act could have some training money into it. This would fit really nicely into that. We're starting to see through manufacturers that grants are opening up for this training, and there's going to be a lot of availability for it. So you have a really nice opportunity to get people up to speed. And, we know we have an aging workforce to begin with in the manufacturing world. So let's fill that in and fill it in with really good high paying jobs.
Adam, yesterday when we did chat and you said about, our dependency on China, and it wasn't that many years ago that we had dependency on our oil, and look what we did. So I think after the smoke clears here with this, and I said it's a soft trend, it's going to change, and we're going to change. I think there's going to probably be some government intervention here talking about, bringing that stuff back into the United States. And you spoke about automation, any other areas. And I think the reason you said about automation was to be cost competitive.
Yeah, I can see it being cost competitive and also quality competitive and keeping your people safe, right? And maybe the higher risk environments where people would be close, what automation could we put in? If we're willing to spend that money right now, let's do it the right way and be able to keep people, further apart and make things just run faster. We really see it in the inspection world, where guys are, used to use SPC and check a handful of parts. Well, inspection is happening so quickly now, we can put it right onto a machine and inspect every part that comes off of it at 100%. So there are ways that we can do this that really increase our efficiencies, but keep people safe.
Well, again, Adam, I really appreciate you taking the time today. If you can hang in there may be some, so we're encouraging people, if they have any questions, that'll be going into a panel where Kaylee's monitoring that. So we may come back around to you, but now I'd like to just shift over to Kristi and the rest of the roundtable for any updates on the areas of workforce, operations, technology. So Kristi, take over for me.
All right, great job. I loved this last half hour. So much information. And one of the questions that has come in, Kaylee, I hope I'm not taking your thunder here, but there is a concern about hand sanitizer dispensers, hand sanitizers in general, and maybe some of the other PPE equipment. So I don't know if Jeffrey or Adam or anybody else who's coming in here for the roundtable, if you have any suggestions on what we should do if we're struggling to find those critical supplies we need to reopen our workforce.
This is Adam Marsh. Actually, on the hand sanitizer part, I think we're at a really interesting part where you kind of can get it right now, but I don't see that it's going to be available long term. And so what the FDA has done is essentially put out the ingredients you need in hand sanitizer to make it legal. So a lot of people are making it right now. We have a lot of people around our area that have started to, hey, I'm going to make hand sanitizer, and jumped into it. And the FDA is not actually inspecting those folks. So what's going to come is they're going to say, okay, well, now you have to do it the right way, and we're going to come in and audit you. And all those people are going to be out of business. So unless they are willing to invest pretty heavily in how they're going to actually implement this, you know, your local distillery isn't really meeting the requirements for this. So if you can get it now, buy it and stock up. Don't wait and think there's going to be more coming. My suspicion is it's actually going to slow down as people have to meet those requirements.
Yeah, I have found that it was nice to be able to pre-order, so I kind of got in the queue with MedZone. So I placed an order, and it took probably 3 or 4 weeks to get it, but that's okay. I was comfortable with that, knowing it was going to come at some point. Are there any other companies that are offering that instead of just randomly trying to go to Staples or Target or somewhere like that to buy it?
We have seen people go to the restaurant stores, actually. So if you recall, the restaurant store is the one that serves all the local local restaurants and supplies them. They were about 3 weeks ago, they were all heavily stocked in this stuff.
Oh, wow. Okay. I think somebody else was trying to come in.
This is Jeffrey.
Adam, this is
I was about to say
Jeffrey.
the same thing. We have business sanitation essential. Clear Design provides a lot of this material for restaurants, and they're open for business, and they have plenty right now. But and with Adam, that they may actually see a shortfall as the other people supplying product in the market get shut down, then they're going to run out of stock.
Yeah, and I also think to some extent, with everybody talking about the fall and there being maybe an uptick, I could see maybe where supply would be short then as well, or even worse than what both of you are anticipating or suggesting. So Darren, can you join us up here in the round table, and Rick? Unfortunately, Katie and Phil won't be here today. Chad, Steve, if you want to join us as well, we'll continue here a little bit along the vein of facilities, operations, cash flow, etc. So Darren, after listening to Jeffrey and Adam, is there anything that you want to add to it or extend upon based on what they shared? You're on mute. There's always one of us.
We hand out an award each other.
Okay, thank you. Yeah, what I started to say was just to, I guess, relate some of their comments, and probably especially some of Adam's comments, to, I guess, the theme of what I've been talking about for several weeks, which is mostly cash flow related. You know, you heard Adam make some comments about resourcing and supply chain and inventory management, and in particular, you know, maybe needing to make adjustments in terms of safety stock and things like that. You that's where I think it just emphasizes and reinforces the need to understand and have visibility around your cash flow needs. And we've talked a lot about that in the last several weeks. I thought I'd take just a minute and talk a little bit about what are some specific things that companies can do to kind of stabilize or even improve their cash flow. And I think it's really about focusing on what I'll call the cash to cash cycle. So what I mean by that is start with when you got to pay cash out, whether it's to stock inventory or to pay an employee to initiate a project, all the way to when you collect that cash from your customer. And I think it primarily comes down to effective use of resources. And I think about this in terms of, or I think you can use kind of your KPIs in your company to identify what your priorities need to be. Because I think, whether it's your workforce, how productive are you utilizing your workforce? If it's inventory, how effective are you managing your inventory? How effective are you scheduling work? How efficient are you with your production cycles and your project management? And then ultimately, what are you doing to manage the cash flow, both with your vendors and customers? And I think we've talked about some of that at different times in the last several weeks, but in each of those areas, I think there's opportunities to really take a hard look at what you're doing and what you can do better.
Adam, I think that maybe you said in your presentation, your comments, in the manufacturing world, it was always lean, and that's kind of going out the window here based on what you're talking about. And another thing that you said is you really have to be anticipatory and thinking about scheduling. We were talking about bringing people in over waves and the production and thinking about processes. So I just see that a lot more time is going to have to be spent upfront planning, not just from the people, but the equipment and then the resources that Darren's referring to.
Right, and
we're seeing really. Go ahead.
You go ahead, Adam.
We're seeing a nice uptick in sort of management has to be in front of this, and scheduling can't be a here's what we're doing today. It's got to be a here's what we're doing this week, and laying it all out for your team because of the staggered shifts and how people are coming in. So we really got to get in front of it, and that makes the scheduling difficult, but it's certainly going to make your employees safer and keep your liability down.
I think that's true for almost any industry. Scheduling is key because that determines how effectively you're utilizing your resources.
We found with the work from home, if you didn't schedule properly, then people were not as effective or efficient when working from home. You didn't do that on Monday morning and have it laid out for the rest of the week, you're in trouble.
Mm-hmm.
But I have heard in the AE space, Jeff, that the utilization seems to be pretty strong still.
So what we found is, for instance, if we have a junior working on construction documents, they are hyper efficient when at home, and no distraction. But the quality of the work on the design side, on the front end, was never as good when they designed in a vacuum. They really needed more senior interaction. They really needed that oversight. Hey, I've been there. I made that mistake before. Don't do it that way. Do it this way. And I'm sure that applies across industries, right? Just experience matters. And so there are certain tasks that are appropriate for work from home. So we will keep that. We will keep work from home as part of our employment contract, actually. But we're going to go from work from home, 100% to maybe 10, 20% only, and to maintain the utilization rate.
Chad, I think you were trying to say something.
Yeah, I'm just going to tie the scheduling, especially during this 8-week cover period, back into the loan forgiveness too. So think about the calculation of an FTE is 30 hours. So not only when folks are scheduled, but how. So an individual working 40 hours, still only counts as 1 FTE for your forgiveness calculation. So that just brings a whole nother wrinkle of importance for scheduling, because it could have a direct impact on your forgiveness during the next 8 weeks as well.
Mm-hmm. All right, so I'm going to open it up for anybody to react to or talk about, but COVID will enter all of our workplaces at some point in time, either short-term or long-term, it will enter. So what tips, tricks, advice does the team have here for responding to that, from a health and safety to just maybe a disruption to production, whether you're in the service industry or you're in the manufacturing side? Raise your finger if you want to talk first. Rick, go ahead.
Well, for those of you that have been on the town hall meetings the last couple of weeks, you'll notice that there's a little bit different background or scenery where I'm presenting from. So yesterday was my first day back in the office, so it is different. When I walked in, there's a handheld thermometer that I have to hold up to my head and check my temperature, every day. And we have, and credit to our management team, really has put out the policies and procedures, sent out a questionnaire saying, you've got to answer these questions to the affirmative before you are allowed to come in. Something I think that was Jeffrey, you mentioned, as we walk in, the doors are all propped open, even the restrooms, so it's a different experience. It's a different world. So my hope, Kristi, is companies have put in place sufficient stopgaps before people even get into the office space, to do those checks, because if you show on that thermometer a temperature over 100 degrees, you can't come in, and you're out and you have to report it. We have protocols, so it's going to be interesting. The challenge is the worlds that Jeff talked about, high-rise businesses with elevators and all that stuff. I quite frankly, I don't know how they're going to come up with those control points.
We had a project on level 70 of one of our buildings, and only one person was allowed up the elevator. This was 3 weeks ago. So one person go up to level 70, and then everyone else had to go find a different elevator. And it was the most inefficient vertical transportation experience I've ever had. And you can't do that. That's not sustainable. That eliminates all the efficiency of having a high rise. So we will definitely have to rethink that in some way, shape, or form. And who knows, maybe it's elevators get divided in two or divided into 4, and you walk into your little cattle slot within an elevator. Who knows? And maybe we're going too far.
Yeah, that's always the question. Are we going to the extreme? As I said, we keep talking about this as being a soft trend. It's going to be, something that, is going to be addressed. We're going to get a vaccine. And how much do you want to do when, to be able to mitigate this stuff?
Right.
I think, Kristi, the other, to respond to your question about, the inevitability maybe of COVID actually, I guess, having cases in your company. I mean, I think that goes to the point of, or the importance of just needing to establish a plan ahead of time. I mean, I can't say that I know necessarily what the actions should be or the response should be, but, I do think it's a good idea to figure that out before it happens.
I agree. And cross-training is critical. Part of that too, because if you only have one person in a particular role, maybe in your IT department, and that person is not able to work because they're really sick, what are you going to do? What is that business continuity plan? Sorry. Just being able to continue operations smoothly as you move forward.
And again, Kristi, this is the whole genesis of being an anticipatory organization. don't just be reacting with the here and now today. Think about those things that are going to disrupt it, pre-solve it, so that you're able to work through it in a timely fashion. Are you going to get them all? Probably not. But I don't think enough people are spending that time, and it's required time that they have to kind of paint their calendar and put that in there. And again, like I said, I think some of the results and the efforts that we've done, really embracing the anticipatory organization and actually applying it to our situation here at Stambaugh Ness has shown its fruition.
Yeah, and Phil's not here to be able to talk further about this topic, but I do want to put it out there as an example for the table here to react to. So is there something that we can skip as we move forward? So the skip it principle is something that we learned as part of being anticipatory. And in talking with Phil this week, I said to him, what are some of the changes that are happening in the workplace? And he said, well, people might have to run additional cabling because you're now changing the layout of the office and the cubicles and so forth. And I said, well, would it make sense just to go wireless? Skip the whole cabling and investing money in that hardware that eventually might have to be replaced and just go to being a wireless environment. And he has seen a trend of more people embracing wireless, but not everybody can go there yet. So is there something else as we think about our facilities and our remote workforce that we should maybe just skip and maybe think differently and pivot in a different direction and instead of trying to backpedal?
Invest in 5G for work from home. One thing that we have had a request to get rid of benching and go more, the cubicle may be coming back, right? And just because of the perceived protection that a cubicle panel provides. It may not be real, because you can still cough over the top, I guess, but the perceived perception. And so far we haven't had many orders, but clients are definitely asking about that.
Jeffrey, haven't you even been asked with some of the materials and all that you use that are going to assist with, protection and that type of stuff? Everybody's familiar with the plexiglass, but I think you mentioned there's even more items that I wasn't even aware of.
Yep, we can specify materials that are antimicrobial on the work surface, or for any surface for that matter. Just does not promote any sort of growth on that surface. And we had already implemented that practice years ago. If you're familiar with LEED and green building and just a good office environment takes into account light, air conditioning, but also the health and wellness of the actual employee. So that is, those materials, while they cost a little bit more, will probably become standard in many, many applications.
So as I bring Tim up on the screen, or not Tim, Tom, I'm sorry, up on the screen to talk with us a little bit more about the R&D tax credits, which Adam opened the door on. Is there anyone that has any last minute comments about skipping something or pivoting in a different direction? Like my example of going wireless?
The only comment I have is go ahead. Go ahead.
Adam, you go.
So in the audit world, so we're part of a lot of ISO 9001 audits and customer audits that they've all gone to offsite audits, and it's been actually it has worked very well. They've never been willing to try it before, and it's saving our customers a lot of money because they're not paying for all the travel for the auditor to come in. So it's been really effective, and our hope is to pressure the registrars to allow that to continue in some form moving forward. Because how are we ever going, think of an auditor or somebody who's seen a lot of companies and traveling around all the time. They're the worst case scenario for spreading something like this. So how do we keep that person kind of, safe and keep them out of our facility? Well, this could be a way to do it, and it's been really effective.
Great. Rick, did you have something?
No, that's the whole idea when you're sharing the concept of skip it. What we want to share with people is so many times people think they have an issue or a problem, and we're saying skip it from the standpoint of many times the problem you think you have isn't the real problem. So by peeling back the onion and really understanding it, you find out that that really wasn't the problem. You know, this whole thing with the pandemic and the COVID-19, that isn't the problem. It's how you're reacting to it or responding to it and what you plan for the future. So that's why we continue to have this anticipatory mindset, promoting, let's look ahead, let's look for that black swan, because it's out there. And the better prepared we are, and the better that we can be pre-active. And I know, Kristi, you tell me that's not a real word, but we use the term pre-active. That's where your mindset has to be. Thank you.
So we had a question come in, which is a good one for the whole panel here, salesmen. So are there any recommendations on what salesmen should do? Because now they may or may not be going to conferences. They may not, or may be going to multiple work sites in a day. Anybody have any thoughts?
I would say the vendors that we deal with have done a magnificent job of having us go to them via their Zoom calls or their conferences. And they've gotten the word out that they have an exciting new product. Let's say it's a new chair or new brick, whatever they're peddling. And we've been able to do a very quick view. They talk about it, and as people come in, and so therefore the face-to-face sales is no longer necessary for that initial contact. The follow-up, send an example of the product, or send them deeper into another website that has more details, has been very successful for us. And I think it's because there's already been a trend of shopping online. We also specify materials online as well. So this was natural for us of having the vendor force us to go to them.
Yeah, good stuff.
Yeah, I think you're spot on, Jeff, that your salespeople, this is an opportunity. They're going to have to rethink how they're approaching this. And I think back 2 years ago when we entered into this track of anticipatory organization, Stambaugh Ness, we were okay in dealing with remote and virtual, but we made it a mission to say we got to get better at this and improve upon it, so that today we can do these town hall meetings. So I think the key is getting that comfort level, get the skills. And I think it's more important now more than ever for your salespeople, your business development people. They should just be reaching out to the customers, checking their pulse, making sure that they realize that, trying to be significant to your customers, not necessarily making the sale, but just showing that you're there, getting understanding where they are. We'll also give you some intelligence as far as planning, looking at upcoming pipeline. But I just think it's a critical and it's a great opportune time to be having that regular outreach to your customers. So it's not going to be jumping in the car and driving. It's going to be a much more efficient and effective means.
Tom, we're going to shift to oh, go ahead.
I was going to say one more thing before I need to leave. I think this is a golden opportunity for architects and interior designers and interior architects, because so many things do have to change, that as opposed to just implementing maybe a developer's vision or a client's vision, we can be the tip of the spear of coming up with new ideas and new concepts, and possibly bring in some other disciplines. So it may make sense to have not only graphics join your architecture team, but maybe an industrial designer join your architecture team. It may make sense to, if you're an interior designer, to have a materials specialist, maybe someone that can create and invent a new material. And this is a golden age for us, to the technology that is out there that allows us to have these face-to-faces. But there is a push to have new creative ideas, and we should all embrace it. Okay. And with that, I need to sign off, and thank you very much. I truly appreciate being part of this.
Thank you so much.
Bye.
We greatly appreciate you participating.
Bye.
Tom, you want to join us?
Absolutely. It's taking a second for my video to come up here, but that's okay. And Kelly, if you would advance the slide one. But Jeffrey and Adam did maybe a great job of setting up my comments, and we appreciate the things that they talked about today. The subjects, obviously, of the roundtable was a lot about innovation, a lot about things you can do, things you can plan to do, things that you will need to do. And that's where I know we talk about this every week, but we want to remind you that there are, in essence, some payback, some subsidy on that, how you can help yourself and reward yourself for those efforts. Whether it's the architect or the engineer that Jeffrey talked about, coming up with these new space designs for buildings, for offices, for green spaces. I think that's going to be important too. I think we're going to see a lot more green spaces in our cities. All that design work qualifies for the research and development tax credit. Even our contractors, if they're doing design build work, that they have those folks on staff to come up with those solutions. There's an opportunity for the credit. Certainly our agricultural producers out there, we know that there's going to be a lot more restrictions, a lot more regulation on our food sources and all of that. So as they come up with new thoughts, I was on a call earlier today with a manufacturer who designs spaces in the food processing industry, and we talked about the myriad of opportunities that they're going to have. Automation obviously is going to replace people even more, and that's another primary source of research and development tax credit. But one topic we've talked about a couple of times in the last few weeks that I just want to give some clarification to. We've talked about software development that could be coming down the pike in your businesses and what that means. And maybe I'll start on the right-hand side of the screen with what doesn't qualify. We're not talking about taking an existing piece of software and just modifying reports, or even taking commercially available software on a virtual platform and customizing or adding some functionality to that. This really has to be something that we come up with internally, either with our own folks or via, other people that we're going to contract to help us. And a couple of examples we gave here is a lot of conversation in today's roundtable about, will people come back on site or will they remain remote? Well, certainly the more people you have remote, the more bandwidth you're going to need. I think we proved that a little bit with our audio issues a little bit earlier today. I know Zoom and Teams and GoToMeeting and GoToWebinar and all of those platforms have been a bit stressed over these last 2 months. Well, if you're developing software, background software, mobile apps or so on to make that respond better on your platform, that could qualify. Any other software that expands your virtual capabilities that you're developing or you're paying to have developed can work. We see a lot of people coming up with apps that allow them to share confidential information with their clients and their vendors. Things you're doing to enhance your cybersecurity or encryption capabilities could qualify. And those are really the type of things that I think fall into all industries. As I said, those activities can be performed by your employees or by contracted researchers. If it is contracted researchers, it's going to be dependent upon the contract terms. We can certainly talk you through that. And, this is a little bit of a complex subject. And if you have any question on whether your activities qualify or not, we're more than happy to have an offline conversation with you about that. So those were just a couple of things we wanted to talk about today to give you some idea of maybe more concrete examples of what we've talked about. We are pushing up against our time here today, so unfortunately we're not going to have a lot of time or any time really to go through questions and answers online, but I think our team's done a pretty good job today of answering just about all of the questions that came in. You should be able to see them in the Q&A panel on your GoToWebinar screen. If there are a couple that we didn't get to, we certainly will get to those, and we'll be distributing those answers to you. So the thing I want to do now is I want to bring Rick back up and let Rick announce the winner of last week's contest. So Rick, if you would.
Tom, we did say that we were going to identify one award, and we had over 30 submissions from last week's participants where they shared ways that they've incorporated a forward-looking activities, to anticipate some of the potential disruptors and pre-solve them. And as we've been talking about, Burris and his anticipatory, this is very critical, so that what we had promised to the participants that we would, pick one submission, and there's actually a copy of the anticipatory organization written by Daniel Burris, along with a personal message prepared by Stambaugh Ness. But after the panel looked at it, it was hard to decide. So we actually ended up with 3 different firms with submissions. So I'm pleased to share the name of McGill Associates. They're located in Asheville, North Carolina. They're an engineering firm that provides a wide spectrum of engineering services, land planning, recreation throughout the southeastern United States. And the attendee last week was Nancy Whitman, the CFO. We have 2 more. Actually, it was CSHQA. This is a engineering firm or an architectural firm based out of Boise, Idaho. What's particularly interesting about this firm, they've been a continuous operating architectural firm established in Boise dating back to 1889. And their financial manager, Gabe Corretto, submitted what they've been doing out there, which was an excellent. So Gabe, our marketing people, as well as Nancy, will be reaching out to you to coordinate the contact names and the delivery. And then right here, located in Pennsylvania, a manufacturing firm, Crescent Industries, based in New Freedom, which is an injection molding company providing integrated single solutions for custom plastic injection molding. Their HR administrator, Holly Kyle, submitted what they've been doing, and they've really taken on some proactive anticipatory action. So congratulations to McGill, to CSHQA, and to Crescent. And to those people, our marketing people will be reaching out to you here in the very near term to get the names and the locations to send your own copy of the anticipatory organization written by Dan Burris. Thank you.
Thanks, Rick. Thanks, Rick, and thank you to everyone who submitted last week, and congratulations to the winners. We hope you enjoy the book and it becomes as meaningful to your organizations as it certainly has to Stambaugh Ness. To wrap up today, we just again wanted to just quickly go over some of the things maybe to consider, places we can help answer your questions or even dive in a little bit deeper if needed. The first of those areas is obviously all things PPP, the Paycheck Protection Program. Chad's talked about this in great length, but we do think it's very important to continue documenting your eligibility for the loan, just in case you were to be questioned on that. Those loan forgiveness calculations will be coming up soon, and certainly, hopefully, we will have some guidance on how to do that. Even maximizing the funding, there are still funds available if you haven't jumped into the PPP program yet. Some of the dollars from round 2 are certainly still available there. So if you have not taken advantage of PPP and you do qualify, we can help you determine that and maximize the dollars there. The technology area that Phil Keeney speaks about weekly, all things cybersecurity, helping you put a remote workforce in place, helping with the training on that, establishing policies and procedures, all very important things to protect our businesses as we go forward in the new normal. On the workforce side, you hear Kristi speak every week. We know unemployment state by state continues to be a challenge as the state systems continue to be quite overwhelmed with the claims, and they've certainly had their issues there. Payroll advisory things, all the credits, all the Leave Act items, the upcoming 941 filings for the remainder of this year and maybe even for beyond look like they're going to be a bit of a challenge as well. So we can certainly help you there if you have questions. And last but not least, the tax savings areas, certainly my area. We talk much about the R&D tax credit. We don't have to need to hit that anymore, but certainly whether their expenses do remain deductible or do not remain deductible on the PPP loan will have a great impact on your taxable income for 2020 and influence some of your planning. We also have all the new provisions that the CARES Act and the other legislation gave us, and maybe even more to come. That's changing all the time. So we want to put as much cash in your pockets as we certainly possibly can. So please do not hesitate to reach out to us if there's anything we can assist with. With that, we'll wrap it up for yet another week. We thank you all for attending. Keep an eye on the emails, the website, the social media. As things change, we'll be getting that out there. And if not before, we'll see you again next week, May 19th at 2 p.m. Eastern. Thank you, everyone, and have a great week. Bye now.